Hello, and welcome to the final report presentation for the Portfolio Optimization and Stock Prediction team. We as a team hope to target the two primary research topics in finance, portfolio optimization and performance prediction. With new technology, many financial institutions are turning to machine learning to mitigate human error and maximize their profit from investments. We use Yahoo Finance API datasets to pull historical stock data to calculate financial indicators such as average return, mean return, risk metric of portfolio, and many more to use for our models. Our goal was to analyze and predict stock behavior and learn more about the research currently being made. We also wanted to find gaps in current research regarding clustering specifically. Markowitz's mean variance portfolio is the current standard optimization technique used in many institutions, but the issue is it cannot identify individual stocks from a large pool. Our goal was to use unsupervised learning to help determine which investments to choose from a large pool of stocks, and supervised learning to predict portfolio performance in the future. The current issue with many predictive models is that they are trying to fit a linear model to a nonlinear reality, which we hope to change. Moving on to our data collection, we had 8 features that we were going to use for each individual stock: average return, volatility, beta, CAPM, Sharpe ratio, average volume, EPS, and RSI. For our range, we chose stocks from NASDAQ, NYSE, LSE, and SGI from November 3rd, 2018 to November 3rd, 2023, a 5-year range of historical data. This does include stock data pre- and post-pandemic, which was interesting to us to see the bearish trends in pharmaceutical and biotechnological stocks. Here we can see an example of our data after collection. Many of these tickers are from the NASDAQ, as we can see on the left-hand side, and we can see all of the calculated features on the right, including average return, volatility, beta, and more. Moving on to cleaning, we noticed that the EPS feature had a lot of null values for many of the stocks, so we removed it as a feature, reducing us to 7 features. Also, average volume was dropped from our features because we felt it provided less value information than the other features. This left us with 6 features. Then we cleaned stocks that had multiple nulls across various features, meaning there was not enough information in these stocks for us to use them in our models. Lastly, we looked at stocks that had an RSI value of 0, meaning it's a continuous 14-day loss with no gain or stagnation of price return as a whole. To find these stocks, we then calculated the z-score for each individual stock, and anything that was greater than 3 was removed. This meant that it lied 3 standard deviations away from the average for a feature, and it was an outlier in our data set. The result was 6,273 stocks that we can use for our various methods and models. Moving on to our methods, we first performed PCA to try and reduce our features from 6 to 3. At first run, we had 100% of the variance by one feature, which is of course an issue. We noticed that it was responsible by RSI, which had a large range and large values compared to the other features in our dataset. Therefore, we normalized our data and reran PCA to find the 3 features that were responsible for the most variance in our data. For our clustering methods, we chose to use k-means and GMM. For k-means, we tracked inertia from 2 to 11 clusters to find that 6 clusters was the optimal choice in running the algorithm. For GMM, we tested performance over various number of clusters and found that 6 was also similar in performance. We calculated average features per cluster in these clusters and then selected stocks from clusters based on portfolio preference for our team, meaning high return, low risk, and low RSI. For our portfolio optimization, we looked within clusters and chose parameters that were most important to us. We also calculated the efficient frontier for our minimum variance portfolio, meaning we wanted as low risk as possible. We did this using average historical returns and the Leo-Deut-Wolff method. Our goal, of course, was to minimize volatility, minimize risk, and maximize returns. For a predictive model, we had to create portfolio value that made it seem as if it were an equity. To do this, we took time series of data of adjusted prices for each stock and multiplied them by associated weights. Keep in mind that this is a proportional view of how much each stock in the portfolio will return based on the weights, combined into one value for each day. We used 90% of our data for training, which was 1,152 values, and 10% for testing, which was 128. We chose to use a neural network as our predictive model because this could account for the chaotic nature of the market. And specifically, we selected an ecostate network to do this. We used PyESN.py for our predictive model. Moving on to our results and discussion. After running PCA, this is how our transformed data appeared. The yellow points here are on the NASDAQ and the purple points are on the New York Stock Exchange. we can see that we have three principal components, and that points on the NASDAQ are still very, very far from that sort of center, meaning that there were still outliers. This makes sense because the NASDAQ tends to be a bit more risky than equities listed in the New York Stock Exchange, but we continue to use all of these data. Next, we look at our k-means clustering. As aforementioned, we use 6 clusters, and here we have 2D and 3D visualizations of our k-means. The first is PCA1 and PCA3, and then PCA1 and PCA2, and then PCA2 and PCA3. The last is a 3D visualization. With this, we then looked at the different feature differences within each cluster, labeling them 0 through 5, and looking at the 6 features used. And then, with this data, we looked at the optimal feature per cluster, or optimal cluster per feature, excuse me. So we noticed that primary trends such as max cap, max Sharpe, and minimum RSI were found in cluster 5. For GMM, we performed similar clustering with 6 clusters, and here we have the various 2D and 3D visualizations with all the different principal components. We did a similar calculation of various feature differences within these clusters, labeling them 0 through 5, and looking at each individual feature. We then also found the optimal cluster per feature, and once again, cluster 5 for GMM as well represented our max CAPM, max Sharpe, and min RSI, which are features we hope to use in our portfolios. Comparing k-means and GMM, we found that the results were very similar as we saw in the graphs before, and they shared optimal features across the clusters. Both k-means and GMM sought to maximize Sharpe ratio and CAPM in some of the clusters while minimizing RSI. Next, we calculated efficient frontier to figure out the volatility of our portfolio that we can use and which stocks we wanted to select in our portfolios. We found that by the graph of efficient frontier on the left here, that at its minimum, we had a 50% return, and we chose various stocks from our clusters 2 and 5, which can be seen on the graph on the right. All of these varied, and the expected annual return on our portfolio was 54.3% with a volatility of 8.9 and a Sharpe ratio of 5.89. This is pretty significant because a Sharpe ratio above 3 is considered excellent for investing, and a 54.3% return with only 9% volatility was significantly better performance than typical portfolios made by hand. Now, with the weights computed, we were able to calculate the value of our portfolio from November 3rd, 2018 to November 3rd, 2023, and here we can see on the graph the target system and our prediction. We use 90% of the data for training, 10% of the data for testing, and our model attempts to predict the values of the portfolio for 10% of the data used for testing, as well as 5 days into the future, or 1 trading week. A lot of this information here was very good. The mean squared error of the prediction versus the actual data was only 8%, and it demonstrated that our model can predict performance of the portfolio relatively accurately, and gave us a good view into the performance in the next trading week. This information could also be used to look for risks of loss in the future so that they could be hedged early to minimize loss. Overall, with an MSC of 8%, we found that our predictive model was very accurate in high-yielding and minimum risk portfolios. It was a good start to our future portfolio performance, and while there was some limitations, we were very proud of it. Thank you.